Hello and welcome to Be Informed. In my last video, we discussed about how to prepare cash flow statement using indirect method. If you haven't seen that video, you can see it in the I button. But in this video, we shall see how we can prepare cash flow statement using direct method. First, we shall have an introduction to cash flow statement, and then further on, we shall see the format of cash flow statement under direct method. There are little changes in both the methods. Guys, you must be aware of the accrual basis of accounting. In accrual basis of accounting, the actual cash flow isn't taken into account. So to find out the actual cash flow, we have to go either by direct method or by indirect method. Cash flow statement using direct method is more valuable. It is more valuable to investors because it shows the actual cash flow, either its inflow or outflow to the investors. However, many people opt for indirect method. So let's get started. So first we need to make it clear that cash and profit are not the same. Cash and revenue are not the same. Profit is revenue minus expenses. And it is for a certain period of time, that is for a duration of time. And it is shown at the end of the income statement. Whereas cash is the bank and balance of a business or cash equivalents at a certain time period. So this is a very clear difference between cash and profit. One more important point, that cash also includes cash equivalent. But most of the companies use cash as cash in bank balance. Cash is considered as the physical money. But there are some other things that we consider as cash equivalent in accounting. We shall see that in detail in some other video. One more thing that you need to be clear about cash and cash flow. There is a difference between cash and cash flow. Cash flow is the flow of cash from the business in and out. It is the flow of cash. Either the cash is coming into the business or cash is going out of the business at a certain point of time. In accrual basis of accounting, we use revenue recognition and matching principle. I'm sure you must be aware of these two principles. In accounting, we use accrual basis of accounting. So guys, if you're not aware of revenue recognition and matching principle, I will tell you briefly. In revenue recognition, we recognize revenue as it's earned, not when cash is received. And similarly, expenses are recognized when they are incurred, not when the cash is paid. It means that as soon as some payment is promised, we make its entry into our accounts. And similarly, when some payment is promised to be received, we make its entry into our accounts at the point of time when it is promised, not when it is actually received. This is called accrual basis of accounting. So from this, it is clear that revenue doesn't mean cash is in, and expense doesn't mean cash is out. And this is the reason that many small businesses fail, because they have a very poor cash flow system. So I can't put more stress on how important it is to track your cash flow. I think enough talking of cash flow, time to move on to format of cash flow statement using direct method. So let's get started. So first we shall write here at the top cash flow statement using direct method also includes the cash flow from three activities. As we discussed in the indirect method, the activities were cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. In this method, we will also consider all these three activities, but cash flow from operating activities is different under direct method. In direct method, we actually see the cash flow, either it's in and out. Okay, that is why it's called direct method, because we directly consider the cash inflow and cash outflow. Whereas in indirect method, non-cash items are adjusted and the actual cash is worked out. In this method, we first consider the inflows of cash, the cash inflow from sales, and then we consider the outflows of cash. Okay, all the expenses, and then we subtract that and the net figure we consider, and that cash inflow or cash generated from operating activities is before taxes, and then we make the adjustment of taxes, and then we finally arrive at the cash generated from operating activities after making the adjustment of taxes. That is the net cash inflow from operating activities. So you will be more clear when I will write here. So first we will write cash flow from operating activities. So under cash flow from operating activities, the first heading is cash receipts from customers. Here one point is very important that I have written here, receipts. It is the actual cash receipts. In other words, it means unrealized sales will not come here. Okay? Next we will write cash paid to suppliers. Here the important word is paid. Okay, this is the actual cash paid. We will consider only the actual paid cash. Okay, now this cash receipts we will write here, and these cash paid we will write here. This cash paid is negative because it is subtracted from cash receipts, and this is positive. This is in bracket, it means it is subtracted from this figure. So as a result, what we will receive is cash generated from operations. We will write here cash generated from operations, and we will write it here like this. So from this cash generated from operations, we will make the adjustment of income tax paid. So here we will write income tax paid. This is also the actual income tax paid. This will also be deducted, so we will write it in brackets. And after deducting income tax, what we will get? We will write here so guys, this amount we get after deducting the income tax paid, we call it cash flow before extraordinary items. This is not the net, okay? If we don't have any extraordinary items, that it usually doesn't occur every year, then this is our net cash flow. But we are making a full format, so we will write here cash flow before extraordinary items. From this, we will deduct the extraordinary items. Cash flow from extraordinary items can either have cash inflow or outflow. If it's an inflow of cash from extraordinary items, then we will add that. If there is an outflow of cash from extraordinary items, then we will deduct it. For example, extraordinary item can be proceeds from earthquake disaster settlement. We will write here. Settlement. This we have written for example. Okay, so this is the inflow of cash. We are getting cash inflow as in settlement of earthquake disaster. This is just an example. Okay, so we will write here the amount and it is addition. So as a after adding this, what we will get is net cash inflow or outflow. If it's negative, then it's outflow. If it's positive, then it's inflow. So here we will write net cash flow from operating activities. We will write it here. So we call it A. This we call it A. This net figure we call it A. So among the three parts, we have done the first part, that is cash flow from operating activities, and we have calculated the net cash flow. So guys, in direct method and indirect method, the change is only in operating activities. The other two activities are the same. That is the investing activities and financing activities. It is both the same under direct method and indirect method. So next I will write it here, cash flow from investing activities. Investing activities. So here we will consider all the investing activities. Investing activities relate to such activities which are the assets of business. These can be either the sale or purchase of a land, sale or purchase of a machinery. So these all activities come under investing activities. For example, let's say we have a purchase of fixed asset. Purchase of fixed asset. So this is an outflow of cash. So we will write it in brackets. Next we can have proceeds from sale of equipment, for example. Proceeds from sale of equipment or machinery. Now this is an inflow of cash, so we will add it. So these were the activities related to investment which we have actually done in our business. Like we have purchased the asset and now we will show it as an outflow, or we have some machinery equipment we have sold out, so that is an inflow, sorry, I'm telling it wrong. That if we have purchased a fixed asset, it means that cash is going out from our business, that is an outflow. And if we are selling an equipment or machinery, it means that the cash will come in, machinery will go out and cash will come in, so that is an inflow. Other items that come under cash flow from investing activities are the incomes that we get from investments. For example, if we have invested some money in some other business, we will receive interest from there. That is an income and that is a cash inflow. So we will write here interest received. It's an cash inflow, so it's a positive item without brackets. Or we can have dividend received. This is also an inflow. We will write it here. There can be many items, but for format we are writing just these. And these two are incomes. Incomes from investing activities. These are incomes. So after calculating all these figures, we will receive net cash from investing activities. This figure we will call net cash from investing activities. Investing activities. And this we will call it B. So the second part is also done, that is cash flow from investing activities. This cash flow from investing activities format is same under indirect method and direct method. But one point that is important here is that it is net cash from investing activities. It is not that it's always positive, it can either be negative. That is shown in brackets. If this figure is bigger than these four figures, the sum of these four figures, we will arrive at a negative. It means there is a cash outflow. That we usually write as cash used. That amount we will say, if it's in negative, it's in brackets, we will say it cash used in investing activities. Here we will say cash generated from investing activities because it's a positive figure and it's a cash inflow. Now we will write cash flow from financing activities. Under the financing activities, the first item we have is share capital. So if there is any proceed from the issuing of share capital, we write it here. Now this is an inflow, it's a positive figure. Next we have proceeds from long-term borrowings. So you see all the items that are relating to financial activities, only that comes under this heading. That is share capital, long-term borrowings. Okay, so this is also a positive. We will write it here. Proceeds. This is proceeds. It means it is a cash inflow. The next item we can have repayment of long-term borrowings. Repayment of long-term borrowings. Now it's a repayment, it's a cash outflow. We will write it as negative. Next we can have interest paid. Now this is also a payment. It's shown in brackets. We can also have dividend paid. It's also an outflow. So as we will work it out, we will get a figure that is net cash from financing activities. So here we will get net cash from financing activities. We will write it as net cash from financing activities. This we will call it C. can see. Now we have three figures, A, B and C. Net cash flow from operating activities, we call it A. Net cash from investing activities, we call it B. And then we have net cash from financing activities, we call it C. If we add these A, B and C, what we will get is net cash increase or decrease in cash and cash equivalent. So this we will write as net increase or decrease in cash and cash equivalent. Which is A plus B plus C. And this figure we get it as here. This can be either positive or negative. If it's positive, it's an increase, and if it's negative, it's shown in brackets, then it means it's a decrease in cash and cash equivalent, which is an outflow. So when we arrive at net increase or decrease of cash and cash equivalents, and to this amount when we add the cash and cash equivalent at the beginning of the period, we will arrive at the cash and cash equivalent at the end of the period, that is the closing balance of cash. So the amount that we will get here is the cash and cash equivalent at the end of the period. So this is also a reconciliation statement of cash, but more of that, we are analyzing the cash inflow and outflow from each activity of business. So here we have seen the full format cash flow statement under direct method. So now we will solve a question using this format and it will be more clear to you. So guys, it is crucial to make a track of your cash flow. As I told you, in small businesses, this cash flow is very, very important because most of the small businesses clashes because of poor cash flow system. Cash flow statement or statement of cash flow is among the three financial statements. Other two are income statement and balance sheet. So here I have one question where income statement and balance sheet is given. Depending on these two, we will make the cash flow statement using the direct method. Direct method, I have already told you here the format. We will follow this format and we shall make a statement of cash flow for this income statement and balance sheet. So let's just start it. So if we take a look at the question, the income statement for the year ended 31st December 2018 is given for the company XYZ Limited. And here we can see sales, cost of sales. Sales minus cost of sales is gross profit. Then the other expenses are deducted, salaries, depreciation, and then we arrive at operating profit. Then interest is deducted and we arrive at income before tax, and then tax expense is deducted and there is the net income. And in the balance sheet, here 2017 and 2018 2 years are given. Cash, account receivable, inventory, plant, total assets. Here is the value of total assets for 2017 and 2018. This is the liability section where accounts payable, salaries payable, interest payable, income tax payable, long-term borrowings, share capital, retained earnings, and then the total liability and equity. So now, following this format of cash flow statement, we will make a cash flow statement for this question. So let's see. This is how we write the title. We write the name of the company and then we write the cash flow statement for the year ended 31st December 2018. We are making the cash flow statement for the year 2018. So here we will write first heading, cash flow from operating activities. This is our main heading. Under this heading, first we will write cash receipts from customer. As I have told you the format, I will write it and then I will show you. So under operating activities, our first item is cash receipts from customers. So we will see in our question from where we are receiving the cash receipts. So here I have made the cash flow statement using direct method for the question. I have shown you already. At the top we write the name of the company, XY Limited. Then the cash flow statement for the year ended 31st December 2018. This is very important to mention for which time period we are making this cash flow statement. So under first heading, that is cash flow from operating activities, the first item we write is the inflow of cash. So here the inflow of cash is from cash receipts from customers. First I am telling you how I have made it, then we will do the calculations. I will show you how to calculate these figures. Okay, just have a look right now. Then cash paid. After cash receipts comes the cash paid. All the cash payments under operating activities are mentioned here. The net value is shown here, that is the net cash flow from operating activities, that is an inflow. Then down here is the investing activities and then the financing activities. And when we do all the calculations, we arrive at a net figure that is an increase in cash because it's a positive figure, so we know it's an inflow of cash. Here a reconciliation of cash is made. The cash at the beginning of the year 2018 and cash at the end of the year 2018, and this figure reconciles with what we have calculated here. The difference in cash from the start to the end of the year reconciles with the cash flow what we have calculated from three different activities. Cash flow statement can be made for any period of time. Here we are making it for one whole year, but it can be easily made for a quarter or 6 months. It depends totally on the requirement. But here we are making it for one whole year, 12 months. So this cash flow relates to 12 months. This time period is very important because we have to make the calculation accordingly. So to look at the cash flow statement, the best way is to start from the end. So here we are at the end, we are given cash at the beginning of the year and cash at the closing of the year. Closing balance of cash and opening balance of cash is given in the balance sheet. As we can see here, it shows us cash 2017's closing balance becomes the opening balance of cash in 2018. So here we have these two figures, and when we deduct opening balance from closing balance, we get this figure, that is net increase in cash. Now we will see how we have arrived at this figure, how this increase in cash is generated. This is the main purpose of making a cash flow statement, that how this 35,000 rupees is generated. So under first section, cash flow from operating activities. Operating activities are the revenue generating activities of our business. first item we have here is receipts from sales. This shows our sales. So to find out the actual receipts from sales, we need to look at accounts receivable. Here you can see we are given with the accounts receivable. So we have to look at this. So to find out the actual cash receipts, we have to make T accounts. So we will make a T account for accounts receivable. So here I have made an accounts receivable T account. Account receivable is a debit balance because it's an asset. So we are given here accounts receivable. So as it's a debit account, the opening balance will come on the left side. So here we will write balance brought forward, BF. So in the accounts receivable, we also mention the sales for the year. So here the sales will come. And whatever the cash is received against these sales, we write on the credit side, that is this right side. So cash receipts. The closing balance of this accounts receivable will also come on the debit side. Because it's a normal debit account, so the opening balance and the closing balance comes on the same side, that is the debit side. Why the cash receipts comes on the credit side? Because these accounts receivables is reduced by the amount of cash that we received against these sales. So that is the reason that cash receipts are coming on the credit side. Now we will see the figures for this from the balance sheet and income statement. So as we can see that accounts receivable account, this opening balance 98 and this closing balance of 120 is given to us, and also the sales that comes from the income statement for the year is also given to us. So we will pick these figures and we will just place these figures in our T account. So the opening balance is 98 and the closing balance is 120 and the sales is given to us is 250. So when we calculate this, we will get to cash receipts. We will add these two and we will subtract it from this. When we add 98 to 250 and from this figure we will subtract 120, we will get the cash receipts. So after calculating, the answer comes 228. So these are our cash receipts. This figure we can put it in our cash flow statement. So let me explain you that how I have arrived to this 228 figure, because I think in my last video the T account I made was a little bit different. So let me do it. So guys, this is how you write a T account. That accounts receivable, here is the opening balance of accounts receivable and here is the closing balance of accounts receivable. These two figures are given to us in the balance sheet. I will show you. So here is the balance sheet and here we are given with 2017's closing balance, which will become the 2018's opening balance, and this is current year's closing balance, that is 120 for 2018. So this will become our closing balance, and the sales we will get from income statement. Sales, it's mentioned here 250. We will just pick this figure and put it in our T account. So this is how I have placed the figures, and when we know that the debit side and credit side are always equal. So this debit side equals 348, which is equal to this credit side 348, but this figure is missing. We are calculating actually this figure 228. We are calculating cash receipts against this sales. So this is our cash receipts. This figure will go to cash flow statement. So this we have calculated by doing the simple maths. This will become next year's opening balance. So we will continue to the account. So 2019, for year 2019, this will become next year's opening balance. So this figure we have calculated, that is cash receipts from customers. This figure we have calculated. Cash paid to suppliers, this we will calculate at the end because this is the hardest part of the calculation. So we will deal with it later on. Moving on to cash paid to employees. So let's see how we can calculate this. For this we will go to salaries payable. From this account we will calculate the cash paid to employees. So we will make an account salaries payable. Salaries payable is a liability. So this will start with an credit balance. So for this we will look at the balance sheet, and in balance sheet salaries payable, this is the opening balance and this is the closing balance. So we will put these figures. So the brought down balance and the closing figure 30 and 42. So the brought down balance is 30,000 and closing figure is 42,000. This account is credited with salaries expense. So whenever the salaries are paid, salaries payable account is credited and salaries expense is debited. So here we will write salaries expense. From this account we want to actually calculate the cash paid to employees. So here we will write cash paid. So opening and closing balance we took from balance sheet, and this salary expense we will take from the income statement. So here in income statement it is shown that the salary is paid. This is an expense. So this figure will come here 80,000. So now we will calculate the cash paid. So this side total is 110. This side is also 110. So from here we will get this cash paid. 110 minus 42 is equal to 68. So this value 68 will go into the cash flow statement. So this value cash paid to employees 68 comes here. So now we will calculate the interest paid. Calculation of interest paid is very similar to cash paid to employees. So let's see. First we will make an account for interest payable. So here we will make an account interest payable. Interest payable is also a liability, so its opening balance will come on the credit side and its closing balance will come on debit side. So brought down balance will come here and carried forward balance will come here. Here we will write the interest expense and here we will write interest paid. So opening and closing balance of interest payable will come from balance sheet, whereas interest expense figure will come from income statement. So let's see. So here we are given with the interest payable. This is the opening balance and this is the closing balance. So we will take these figures. So opening balance is 2 and closing balance is 3,000. Now we will look for interest expense from income statement. So the interest expense from income statement, we get 8,000. So this figure we will put in our T count. So interest expense from income statement is 8,000. So the total of this side is 10. So credit side equals debit side. So this gives us 10,000 minus 3,000 will give us interest paid, that is 7,000. So this figure will go into the cash flow statement. This is the actual cash paid for interest. So here you see the interest paid figure is 7,000 and it is an outflow. So this is deducting from inflows. So now we will calculate the income tax paid. So for this, the process is also the same as we calculated the interest paid and cash paid to employees. We will make an income tax payable account. So here we will write income tax payable. So this is also liability, so the opening balance will come on the credit side. So here we will write brought forward balance and here we will write the closing balance, the carried forward balance. Here we will write the income tax expense. And here we will write the actual cash paid for income tax. So tax paid. Opening and closing figure will come from balance sheet, whereas income tax expense will come from income statement. So let's take the figures. So income tax payable, here is the opening balance and this is the closing balance. And from income statement, this is the income tax expense. 9. So we will put these figures into our account. So the opening balance is 4 and closing balance is 6. Income tax expense from income statement we got 9. So the total of this side is 13 and the total of debit side is also 13,000. 13,000 minus 6,000 will give us 7,000. So this income tax paid will go to cash flow statement as income tax expense. So here we have written the income tax paid. This is the actual cash paid, 7,000. So the last thing we are left with is cash paid to suppliers. So this is also a liability and this figure will come from accounts payable, an item of balance sheet. So we will make an account of, we will make a T account of accounts payable. So here we will write accounts payable. This is also a liability. So the opening balance will come on the credit side and the closing balance will come on the debit side. So here we will write inventory purchase. And here the cash paid. So this opening and closing balance we will get from the balance sheet. So let's see. So the accounts payable opening and closing balance are here 95 and 105. So we will write it here. So cash paid to suppliers, for that we have to make accounts payable. So accounts payable is a liability and its opening balance will also come at the credit side and its closing balance will come at the debit side. The next item of account payable is inventory purchase. So inventory purchase is something that we cannot find directly from income statement or balance sheet. Inventory purchase, as we see, we cannot find from any of these information given. This is the information from income statement and this is the information from inventory and this is the information from balance sheet. Here we are given the inventory opening and closing balance, but we are not given how much inventory is purchased. This inventory purchase is related to cost of sales. So here one point is very important to understand, that accounts are always prepared on the basis of matching principle. Matching principle is that we only recognize the revenue. Matching principle states that whatever the revenue is generated during a certain period of time, the expense related to that revenue, only that revenue is taken into account for that period of time. It means that you match the expense to its revenue. Okay, we cannot take a revenue in relation to an expense that is incurred at some other period of time. So this is a simple matching principle. So here we are given the cost of sales, but we are not given inventory purchased. So we need to make another account, T account of inventory. So here we will make another T account, inventory. Inventory is an asset, so its opening balance will come on debit side and its closing balance will come on credit side. So inventory is always increased with the inventory purchased. So whatever the inventory we purchase, we make a debit entry. So here we will write inventory purchase, and inventory account is credited with, and the inventory account, we credit this account with cost of goods sold. So on this side we write cost of goods sold, and income statement is debited with this amount, cost of goods sold. So its second entry is made, its debit entry is made in income statement. So from here we can take the opening and closing balance of inventory from balance sheet and this cost of goods sale from income statement. So let's take the figures. So for inventory, here it's shown in assets. Inventories prior year balance sheet closing figure become this year's opening balance. This 68,000 is the opening balance of current year. So 68 and 94. 68 and 94. This cost of goods sold is the cost of sales. This 60,000 we get from income statement. So we write it here 60,000. So we will add this up. So this adds up to 154 on credit side. So equals the debit side. So from here we can find out inventory purchase by subtracting 68 from 154. So this gives us 86 as inventory purchase. So this amount will go to accounts payable here. This 86 we will write here, and the accounts payable opening and closing we will get from balance sheet. Accounts payable opening and closing are here, 95 and 105. So opening is 95 and closing is 105. So add up this side. This adds up to 181. So this side is also 181. 181 minus 105 will give us the cash paid. So this gives us 76 as accounts payable. Cash paid in relation. So this 76 is the actual cash paid for this. So this 76 is the actual cash paid to suppliers for this purchase of inventory. Because this inventory is credited, this inventory purchase is credited, and whatever the payment is made is debited here. So this goes to suppliers, cash paid to suppliers. So here cash paid to suppliers 76, it's an outflow. So now we have calculated all these, resulting in net cash flow from operating activities, that is 70,000. So now moving on to investing activities. Investing activities relate to items which are non-current items. These are normally the fixed assets of a company. So any purchase or sale related to these items, or any cash receipts from the sale or purchase of these items, come under this section. It also includes the investments outside of your business, like if you have invested in some other company, or you have bonds, or you have bought the bonds or shares in other company, so that comes as an investment in other company. So all these incomes from those investments also come under this section. So from cash flow format, we know that under investing activities all these items comes. And when we look at our balance sheet, we come to know that we are given with the fixed asset, property, plant and equipment. So this is the prior year's closing balance, which will become the current year's opening balance, and this is current year's opening balance. So we need to make an account for property, plant and equipment, and from this account we will come to know is there any cash purchased or not. We can see from these figures that there is an increase in there is an increase in property, plant and equipment. So we need to make an account. So the next account we will make for property, plant and equipment, PPE. So it's an asset. So opening balance. So property, plant and equipment is an asset. So opening balance will come on debit side and closing balance will come on credit side. So property, plant and equipment account, opening and closing balance, we can take these figures from balance sheet. Property, plant and equipment account is credited with depreciation expense. So here we will write depreciation expense. I am writing the abbreviations. And here the figure that we will get is the purchase of property, plant and equipment. Property, plant and equipment account is always debited with an increase of equipment, property, plant and equipment. So whatever there is an increase comes on debit side, and this account is reduced with depreciation expense because this property, plant and equipment is depreciated. So in PPE account, here comes the purchase of PPE, and on this side comes any sale. If we sell any PPE, the value comes on the credit side because it is a decrease in the value of property, plant and equipment. And depreciation expense is also a decrease in the value of asset, so it comes on the credit side. So this depreciation expense is shown on the debit side of income statement and credit side of property, plant and equipment. So for opening and closing balance, we can take from balance sheet, and this depreciation expense we can take from income statement. So first just put these figures and then I will tell you. So opening balance of PPE is 202 and closing balance is 234. So 234 is the closing balance. Okay, now we will take the depreciation. Depreciation expense is 23. So this depreciation expense we will write here 23. Here I want to make you clear that at this point we are not given with fixed asset register particularly in this question. So we have to make some assumptions. First, we are ignoring the accumulated depreciation account. Second, that we are ignoring any gain or loss on sale of this asset. Then third one is we assume that this purchase of property, plant and equipment cost 70,000. So these are the assumptions that we are making particularly in this question. Otherwise, if we are given with fixed asset register, it is easy to calculate the purchase, or if we are given any additional information, we can take that information from additional information. We can take this value from additional information. But here we are assuming that this value is 70,000. So I'm writing this 70,000 here. 202 plus 70 gives us 272. This equals the credit side. And when we subtract this, so this gives us 15 as a cash receipt from sale of property, plant and equipment. So this item will go in the cash flow statement under investing activities. So here you can see that this is the purchase of property, plant and equipment that we have assumed because no additional information was given in this particular question. And then second, cash receipts from sale of property, plant and equipment. This is one we calculated. So working on these figures will give us net cash flow from investing activities. This figure is negative, so it means that it is the cash consumed. It is the net cash consumed in investing activities. Don't worry, we have done all the hard work. The cash flow from financing activities includes all the activities, the cash from all the activities that are related to the share capital, borrowings, bonds, all these things. Any outflow or inflow of cash from these activities come under this section. We can see that proceeds from long-term borrowings. So how we know we need to take proceeds from long-term borrowings? This we can see that from balance sheet, long-term borrowings are given. Long-term borrowings for the prior year is 80,000, whereas for the current year it's 1 lakh. So there is a change of 20. If we subtract these two figures, we can easily see that there is an increase of 20,000. The proceeds from long-term borrowing. So this we have shown here, proceeds from long-term borrowings 20,000. So in this question only one item comes under financing activities. We have three figures from three different activities. We will add up and we get the net increase in cash. This is 35,000. So this is what we were looking for actually. We did all the calculation to find this value, which reconciles with our opening and closing balance difference. This is net increase in cash, 35,000. If these two figures does not reconcile, it means that we have done some mistake. These two figures must need to be reconciled. This is the opening balance of cash and this is the closing balance of cash. This we get from balance sheet. As you see, as you look at balance sheet, here cash of prior year's closing balance becomes the current year's opening balance, and this current year's closing balance is 185. So when we subtract these two figures, we get 35,000.